What's up, millennials? Welcome to part 3 of this series about investing for beginners. So in the last two videos, we spoke about how to track your income and your expenses, and also how to lower your expenses and raise your income at the same time. So hopefully that information has helped you, and now you have some extra money left over at the end of the month. So in this video, we're going to talk about what to do with that money. In this video, we're going to talk about the difference between saving your money and investing it. All right, so let's get started. So let's first talk about saving your money. And just to be clear, in this video, we're going to talk about the money that you won't need for the short term. I'm going to assume that you already have your financial buffer of at least 3 months, or preferably 6 months. And I'm also going to assume that you've already put aside money for any short-term expenses you might have. For example, for maybe a car replacement, or you need a new phone, or you're saving up for a mortgage for your house. So today we're talking about the money that you're left over with after all those expenses. All right, so when I ask people why they aren't investing in their money, one of their biggest reasons is that they are afraid to lose money. Well, that's kind of ironic because investing has always been more profitable than saving your money in the long term, especially at this very moment. And apart from that, right now, if you're saving your money, you're actually losing money over time. Why is that? Well, let's check that out. Well, there are two things. First of all, you have a low interest rate, and then there is inflation. So let's first take a look at the interest rate, okay? Personally, I live in the Netherlands, and here we can see a graph of the highest interest rates in the Netherlands. And as you can see, the interest rate in the Netherlands has been decreasing since about 2008 until 2009. Personally, my own savings account right now pays me about 0.01% per year, okay? Let me repeat that, 0.01%. That's almost nothing. Now, this does depend on the country where you live, because if we look at the United States, for example, we see that the interest rates are a bit higher, quite a bit higher actually. You can see interest rates of, well, let's say 0.6% over here, some even 0.8%, some 0.7%. So that is a little bit higher. And by the way, I'll put all the sources of these links in the description as well, so you can check them for yourself. So what I'd like you to do right now is to pause this video and find out how high, or well, how low your interest rate is in your country, okay? You can check simply the interest rate that you are receiving, or you can also go to Google and just type in something like, let's say, interest rate. Well, we already have it, interest rate, savings account, and for example, Germany, or wherever you live, you put Spain or France, and you can simply take a look at the links that are provided by Google, and you see more or less how high the interest rate is, okay? Cool, so now you might think, well, okay, 0.01% and even 0.8% is not that much, right? But I'm not losing any money, right? Well, there's another problem, and that problem is called inflation. So what is inflation? Well, it basically means that the prices of things go up and your money becomes less valuable. Let's explain that a little bit better with a simple example. So let's say, for example, you have 30 euros, okay? 30 euros. And in 2010, you like to drink beer, all right? In 2010, one beer was costing you 2 euros per beer. Now in 2020, cost of the beer has gone up to about 3 euros. Now, how many beers were you able to buy in 2010? 15, right? So yeah, 30 euros, each beer was 2 euros, so 15 beers. How many beers were you able to buy now in 2020? Well, only 10 beers. So this way you can see that with the same amount of money, you're able to buy less over time. First you were able to buy 15 beers, and now you're able to buy only 10 beers. So basically price is going up, but your purchasing power and therefore the value of your money is simply going down over time. Now, maybe that's a little bit exaggerated, but I do hope that you understand the concept. Now, on this website, you can see the inflation rates of almost all the countries in the world. So let's take a look at the inflation rate in the United States, for example. Here you can see the inflation rates for the past year. Let's take a look at the last 25 years, okay? As you can see, according to this graph, it has been hovering around the 2% mark. Right now, we're a little bit below that, about 1.6%. But in general, it has been around 2%. And if we go, for example, to, well, let's say the Netherlands, where is it? It's about here. And we go to inflation rate, to the graph. And we go to the 25 years as well. It's basically pretty much the same. It's a quite similar graph, also hovering more or less around the 2 mark. And right now, it's quite a bit lower. Well, this was a few months ago, I believe. Right now, it's about 1.5, 1.6%. So what this basically means is that you're basically losing 1.5 to 2% of your money per year because of inflation. So even if you have an interest rate on your savings account of 0.8%, you're still losing money each year. Let's take a look at my compound interest calculator. And before I do so, a shameless plug over here for my free ebook. You can check that out in exchange for your email address so that I can spam you every day. Nah, just kidding. So let's take a look at the calculator, right? Let's say right now you have 5,000 euros or $5,000, whatever currency you want to use. And you live in the Netherlands in this case, okay? So we're going to say 5,000 euros. Annual interest rate was 0.01% on our savings account. Inflation rate was about 1.5%. Let's take 25 years of growth in this case. And let's say that because we were paying so much attention to the first few videos of this series, we have 200 euros each month that we're able to add to our portfolio or add to our account, okay? So what we can see is that in total, we would have invested 65,000 euros. And after 25 years of time, you can see that you would have lost more than 11,000 euros. So in total, your portfolio would be worth about 54,000 euros. So basically what I'm trying to say is that if you're investing at this rate with this inflation rate, well, the only thing that's going to happen to your money over time is that you're going to lose money, okay? So that's it for saving your money. I hope I made my point clear. Now, let's take a look at investing, okay? On this website, we can see the historical returns of the S&P 500. What is that? Well, the S&P 500 is an index fund, which is basically like one big basket filled with stocks from the 500 biggest companies in the United States. And you don't really need to pick themselves. So if you don't have time to pick all these different companies, then what you can do is simply invest in an index fund in this case. So many people also use the S&P 500 to pretty much know how the stock market is doing more or less. I'll talk more about the S&P 500 and ETFs in a later video. Let's first take a look at the data of this website. Here you can see the annual changes in percentages for each year. So for 2020, well, it hasn't finished yet, but for now, it's 4% up for the year. 2019, it was up almost 29% in a year. 2018 was down minus 6%. And then you can see for each year if it was up or down and how much it was up or down. So in general, there are quite a lot of green years, as we can see. But there are some major red years as well, especially in the year 2008, the financial crisis, of course, when the stock market went down 38% in one single year. And also at the dot-com crisis from 2000 to 2002, you can see that the stock market dropped a lot. First 10%, then 13%, 23%. But in general, you see more green years than red years. Now, I've copy-pasted this data of these last 25 years in this Excel spreadsheet. And as you can see, these are the years from 2019 all the way back to 1995. And the percentages are right next to it. So what we can see is that if we take the average yearly return, we can see that it's 9.7%. So that means that on average, you in the last 25 years could have gained 9.7% on average per year. Now you might be saying, well, I don't want to lose like 38% in one single year either, right? Well, you might remember this from a previous video in this series, that investing is for the long term, okay? It doesn't really matter what happens in one single year. What matters is that you're going to be investing for 20 years, 30 years, or even 50 years. So one single year in all those years doesn't really matter. You simply need to look at the average numbers, just as we've done just a second ago. So let's try to hammer that down with one more image. Here in this image, we can see 3 graphs. And let's start with the first one. This is the easiest one, okay? This is simply a graph of the average annual returns of the stock market. So pretty similar to the data we have just been looking at. Here you can see that if it was a green bar, then that means that that year was a positive year, that people earned money that year. And if you see a red bar, well, that means that people lost money that year in the stock market. And here on the right, what you can see is that 73% of all these years from 1926 until 2019, 73% of those years were green years. 27% of those years were red years. Now let's take a look at the second graph over here. And this one is a little bit more difficult to understand and also a little bit difficult to explain to you. So I'm going to do my best, and you might have to pause the video or maybe rewind this video a few times to fully understand it. But here we can see a graph of the 5-year annualized returns. What does that mean? Well, if we take a look at the last bar, for example, this one, which should be right above 2019. This bar indicates the average return of the last 5 years, okay? So the years 2019, 2018, 2017, 2016, and 2015, right? So the average return of those 5 years. If, for example, a bar is above the year 2000, well, it would be the average bar for the 5 years before that. So 2000, 1999, 1998, 1997, 1996, those 5 years. And then when we look at the graph on the right-hand side, we can see that 87% of those 5-year periods were actually positive periods, okay? And 13% of those 5-year periods were negative ones. So that means that if you would have held your money in the stock market for at least 5 years, then historically seen, you would have had a probability of about 87% that you were going to earn money over that time. And then the third one, the third graph over here, is quite similar to the 5-year annualized returns, but these are the 15-year annualized returns. So what we can see here is very similar. If you take a look at the last bar, for example, again, the one above 2019, this bar is the average return of the preceding 15 years time. So that would be from 2005 all the way to 2019. And as you can see, every single bar here is green. And also on the right, you can see that 100% of these bars are green. So what does that mean? Well, if you would have held your money in the stock market for at least 15 years, then historically seen, the probability of earning money would have been 100%. Now you do need to take into account this very little line of text over here, which says that past performance is no guarantee of future results, okay? If in the history of time, the 15-year periods were always green, well, that doesn't mean that in the future, that's going to be the same as well. So you might lose money if you keep your money in the stock market for more than 15 years, but the probability is very, very low. So let's go back to our compound interest calculator for a second, which we were using before to calculate how much money we would be left with if we would save our money. So then the annual interest rate was 0.01%. But now let's change it to the 9.7%, which we had calculated before, which was the average return of the last 25 years in the stock market, or at least in the S&P 500. So that's 9.7%. And what we can see, let's first go back to the 0.01%. The future value of our portfolio was almost 54,000 euros, right? We would have lost 11,000 euros. Now let's go to 9.7% per year. And now we see that our future value of our portfolio is 219,000 euros. And we would have won or earned 154,000 euros. All right, so there you have it. Now you know the difference between saving your money and investing your money. And now you know about inflation as well. I hope you're more inclined to start investing now. So in the next video, we're going to talk about different ways how to invest. So I hope to see you there. Bye-bye.